liability account? Is it a stockholders' equity account? Is it a revenue account? Is it an expense account? You need to identify what account is affected because we need to make an entry to that account. We need to make a journal entry. All right. 4, what do? We need to record the amounts, right? So we stopped. Remember, accounting's easy. All right. Then the transaction. Does a transaction exist? If it does, move on. So once we've determined a transaction exists, what accounts are affected? Now determine, is it asset or liability? Then we record the transaction in the form of a journal entry, right? We hit which assets increase, which assets decrease. Like I said, if it's an asset, it decreases on the left, or increases on the left, decreases on the right. Liability, it decreases on the left, increases on the right. So 4, record the transaction in the form of a journal entry. We're going to do that. Okay, and then 5, T account. Does the transaction balance? Do we have a T entry over here and an entry over there? Does our T account balance? What's the sum of the T accounts? Is that sum is our ledger balance? All right. So start every time we have a transaction or event. We need to start the analysis. And how do we start the analysis? Walk through those 5 steps. Okay. Moving on. We're gonna get into some transactions that occurred to Roundbelly in the month of August. First transaction. Roundbelly is incorporated on August 1st. The company issues stock to the shareholders in exchange for $75,000, which is deposited into the company's bank account. All right, stop. Remember, accounting's easy. All right, transaction. Did something happen? Is there an observable event where goods, services exchanged? In this case, yes. $75,000 was exchanged for stock, a share, a piece of paper. If somebody determines it's worth $75,000, then it's worth $75,000, and that exchange happened, we received the cash, all right? So, identify the accounts. What are the accounts? I just said one. Cash. We received cash. Let's increase the cash account. We just received cash. We took cash in. Our cash is going up. How do assets increase? They increase on the left. Look up here. Cash. We debit the journal cash. Increase on the left. $75,000. Okay, and then what else increased? Our contributed capital. It increased. You know, somebody gave us money, cash, but they also increased our capital. Our you know, the financing money that we have to now invest. That capital increase. Liabilities and stockholders' equity increase on the right. So we're going to increase that right there. And you'll see in parentheses I walk through increase asset, increase stockholders' equity. Debit $75,000, credit $75,000. That is our journal entry. Now, if you look, I walk you through A, B, C, D, E, F, G, H. Here, the T accounts for cash. You'll see A, increase on the left. Then we'll find contributed capital. A, increase on the right because it's a stockholders' equity account. Moving on. B, a construction company renovates an old pier and dock space at a cost of $50,000, which Roundbelly pays in cash. Okay, stop. Remember, accounting's easy. All right. So, transaction. Were goods and services exchanged? Yes. $50,000 was given in exchange for a renovated pier. All right. So we definitely have a transaction. Now, what accounts are affected? Well, we paid cash, so cash went out the door. Cash decreased. Let's put cash on the right. All right. Up here, B. Cash on the right. It's a credit, $50,000. Assets decrease on the right. Decrease in cash. Machinery and equipment, in exchange for that $50,000, we got a renovated pier. We're going to put that in machinery and equipment because that is going to help us produce goods and services later. That's an investing activity. It's going to help us produce goods and services later, but it is an asset. It's an asset. It increases on the left. Bam, journal entry, increase on the left, $50,000. Now, let's find the T accounts, right? Because the T accounts, remember, we got it from the journal entry. We need to put this in the ledger or a T account. So we say, here, B, cash, decrease on the right. The sounds of San Francisco, right? We got an ambulance coming by. That's all right. We'll keep going. B, cash decreased on the right. Where else? Where else do we go? B, cash, or machinery and equipment. We increase that asset on the left-hand side. All right? Move on. C. Now, I may be going through this fast, but that's all right. You can watch this lesson over. Just understand, you know, when we got an asset, okay, stop. We got to go through the start analysis, determine how everything's affected, and you can walk this through on your own. just by looking at the cheat sheet, or you can watch this lesson again. Alright, so let's go move on to C. C, what happens? Round Belly installs $15,000 of machinery and equipment in the dock, paying $10,000 in cash, and promising to pay $5,000 at the end of the month. Alright, so we got $15,000 in machinery and equipment. Alright, so let's stop. Remember, accounting's easy. Transaction. Were goods and services exchanged? Did we get something? Yes, we got. What did we get? We got $15,000 of machinery and equipment. All right. So we definitely got something. We definitely paid for cash, and we definitely said, well, we're going to give you some other money too, but just later. Okay. Well, that's a definite event. Goods and services were exchanged. So C. What did we get? We got an asset. Asset increase left. Debit. Asset increases left. $15,000. And then, so what else happened? We paid $10,000 cash. Cash went out the door. That's a decrease in an asset. Decreased asset on the right. Credit asset. Credit cash. What else did we do? We said, well, maybe we don't have all the cash now, or maybe we want to keep some of the cash just in case something happens. We'll pay you that cash later. We're going to pay you $5,000 later. Okay, well that's a liability. That's an accounts payable. That's something that we're going to owe in the future. So that's a liability. How do liabilities increase? Liabilities increase on the right. Credit accounts payable. So that's the journal entry. Machinery and equipment, debit 15. Cash, credit 10. Accounts payable, credit 5. Go through the T accounts. We see it here. You got C, 10,000 cash, credit. Machinery equipment, $15,000 debit. Remember, because that's all going. We got $15,000 in machinery equipment. Accounts payable. Remember, C, increase on the right. Liabilities increase on the right. The equation's got to equal. All right, moving on. D. Round Belly borrows $25,000 from a bank, depositing those funds in a bank account and signing a formal agreement to repay the loan in 2 years. Stop. Remember, accounting's easy. All right, let's look at this. Did a transaction occur? Were goods and services exchanged? Did we get resources, and then are we obligated to pay resources back in the future? Yes, that's an observable event. $25,000 of cash went into our bank account. Cash increased. Cash debit, right? Debit 25,000. Cash increased. Debit left side. What did we do? We increased the liability. We were promising to pay in the future. You know, what do we do when the liability increases? Right side, credit. Credit, notes payable right here. That's the journal entry, D. Now we go to the T accounts. Cash, D, increase. Notes payable, D. Liability, increase on the right. The equation equals assets equals liabilities. 25,000 equals 25,000. Move on. E, Round Belly orders 1,000 of wood, nails, sheet metal, and shop materials. None are received. Stop. Remember, accounting's easy. Alright? Did a transaction occur? We called up, ordered something. Did we receive anything? No. Nothing's received. Were goods and services exchanged? No. If those never arrive, do we have to pay for them? No. Does a transaction exist? No. What do? Do nothing. Move on. F. Round Belly buys $10,000 dry docking crane, paying the full amount in cash. Stop. Remember, accounting's easy. Transaction. Did a transaction occur? Yes. We paid $10,000. We got $10,000 of machinery and equipment. All right. So what do? Journal entry. You know, A. Accounts affected. What accounts are affected? Machinery, equipment, and cash. Okay. What's the journal entry? Machinery, equipment increase. Debit. Increase asset. Debit 10. Cash went down. Credit. Cash went down. Credit. All right. G. Moving on. Okay. Well, if we can find that in our T accounts. Same thing. You can follow it. But G. Moving on. Round Belly pays $5,000 owed to the equipment supplier in C. You remember we told them, hey, we're going to pay that to you at the end of the month. All right. So stop. Remember, accounting is easy. Let's determine, did a transaction exist? Were goods or services exchanged? Well, yeah, we paid them the $5,000. We're out $5,000. Cash went out the door. Something happened. Services, resources were exchanged. Resources, we sent them $5,000. All right. So, what are the accounts? Well, we talked about cash, and let's think. We recorded it as an accounts payable previously, so we're probably going to decrease that accounts payable. So that's going to be the account, right? We're going to decrease that accounts payable because we're not going to owe that anymore because we just paid it, all right? So how do we decrease an accounts payable? Well, it's a liability. How do you decrease the liability? Debit. Debit a liability is a decrease of the liability, right? Debit liability. Debit accounts payable. How do you decrease an asset? Credit, cash, $5,000 right there, okay? And then you can follow the T accounts. So as you can see, the T account, accounts payable, C here, we recorded the transaction. G here, we're taking it off. So that's a wash. When we come to our sum, it's going to wash. It's going to be 0. We recorded it, we paid it, we don't owe anymore. So the, our sum, our ending ledger balance is going to exclude that wash. But the transaction occurred, we entered it in a journal. All right. H, moving on. Round Valley receives 800 of supplies ordered in E and promises to pay for them the next month. All right, remember in E, we ordered this stuff, but nothing got here, so we didn't record anything. Well, now we receive stuff, so yeah, now there's an exchange of resources. We're getting the materials, and we're going to have to pay them. We're going to pay those. All right, so what do? Well, stop. Remember, accounting is easy. All right, did the transaction exist? Yeah, we got resources, we got supplies. Now, what are the accounts? Well, we got supplies. It's probably our supplies account, right? That's an asset account, supplies. That's going to provide us a future benefit because we're going to produce something with it. We're going to provide a service with it. So that's an asset, right? Increase asset. How do you increase asset? Debit asset, right? 800. Liability. Well, now we owe 800. We didn't owe it before, so that's got to increase the liability. How do you increase the liability? Credit liability. Credit 800. There you go. That's the journal entry. Find our T account. 8 right there. Credit, accounts payable. Supplies. Debit, supplies. All right? Now, all this, so what we're going to do is we're going to sum all these transactions. And remember, on the right-hand side for an asset, those are going to decrease. So you subtract all this, you sum it, and you get here, and you say, oh, our ending balance in cash is 25. Our ending balance in supplies is 800. Accounts payable is 800. Notes payable is 25,000. Machinery equipment is 75,000. Contributed capital is 75,000. So those are our ending ledger balances. And remember, on the other side of the cheat sheet, I said the ending ledger balance is what goes to the balance sheet. Well, let's take this stuff to the balance sheet. Cash, 25,000. Supplies, 800. Total current assets, 25,800. Machinery equipment, 75,000. Total assets, 100,800. Accounts payable, 800. Notes payable, 25,000. Well, total current liability is 800, right? Notes payable, we're going to pay it later, so that's non-current. So total liability is 25,800. And remember the contributed capital. Oh, we got that. That increased our stockholders' equity. That's a financing activity. That increases our capital. All right, we're recorded down here. So we add our liabilities plus our stockholders' equity, 100,800. All right. Do our assets equal liabilities plus stockholders' equity? Does that statement hold true? Yes. Right. All right. We're good. Now, what I've done here is I've included all the journal entries referenced, the T accounts referenced, transactions referenced. You can walk this through on your free time. I wouldn't want to do this on my free time, but when you're studying, walk it through. Also, in this middle section right here, what I've done is said the basic accounting equation: assets equals liabilities plus stockholders' equity. I've just laid all these transactions out in a simplified form. I'm not going to do this anywhere else, but this is just all the same information but presented differently, visually differently. So I'm going to walk this through, see if it makes sense. If it doesn't, just go through this other stuff. This is just here to present the information in a different light. Everybody learns differently, but this is the same information just presented differently, vertically versus horizontally. What are you going to do? All right, but remember, this is how we get to the balance sheet, our ending ledger balances. We take all the transactions, stop, we do an analysis, record a journal entry, put it in the T account. Our ending ledger balance gets to the balance sheet, and here's our ending balance sheet: assets equals liabilities plus stockholders' equity. That's lesson 2. Thank you.